Good day, students. You're welcome to this edition of Scholars Universal Online class. This is financial. Good day, students. You're welcome to this edition of Scholars Universal School Online Teaching. This is financial accounting. In this class for today, we'll be discussing the topic issues of shares. Now, to go further in this topic, I expect that you should have a proper understanding of the topic of double entry and components account. Okay, at the end of this topic, I expect that you should be able to define shares, state the types of shares, state the classes of shares. You should be able to write short notes on the issues of shares, and you should be able to post issues of shares account at par, at discount, and at premium. Alright, so when we talk about shares, what comes to your mind? Don't forget, while we discuss the types of companies or business organizations, we said we have some different types of business organizations, starting from the sole proprietorship, which is one-man business. And for sole proprietorship, we know that the owners drops the capitals for the business, that is, the money used in starting the business. And for partnership, we know the set of partners put their resources together to form the capital of the business. And for companies, we know that the capital of companies are gotten from the sales of shares to shareholders. That is, they will sell shares to the members of the public, and the people that subscribes the shares, that subscribe for the shares, are called the shareholders. And okay, so at the cost of issuing shares to the members of the public, they must have gone through some certain process. So that is what we want to consider in this topic for today. Now, to start with, what is shares? Shares, we say, is a unit of capital of a company. Okay, it says share is a unit into which the authorized share capital of a public limited liability company converted for sales to the members of the public as a means of raising funds to meet the need of the company. You will agree with me, while that because of the company account video that was shared some weeks ago, we explained that for every company, at the point of registration, they must have sent some set of documents to the registrar company, which is the Corporate Affairs Commission, as we have it in this country, Nigeria. And part of the document that will be sent to the Corporate Affairs Commission, which is the registrar company, is the Memorandum of Association. And your Memorandum of Association, your authorized share capital will be stated there. And in your authorized share capital, the unit of shares that you can sell, the unit of your capital that you can sell to the members of the public, is what we call share. So we are saying that share is a unit of capital of a company. And it is pertinent to note that authorized share capital is also known as your registered share. That is, the registered share that you could raise from the public to commence or continue business. Now, through the sales of shares, a company generates funds to carry out its objectives as a going concern, and those who buys and owns the shares are referred to as shareholders. Okay, so the issue of shares denotes the process of having unit of company's authorized share capital sold to members of the general public or members of the company. And the process usually starts by informing the general public via a document known as prospectus. So the process starts from, okay, the company would advertise through a document that we known as prospectus. And prospectus contains the number of shares on offer, the nominal value of the shares, the issue price, which is the selling price of the share, and the issuing house. Usually it's a bank. So they will tell you, okay, this is the amount of shares that we can sell, this is the amount we are selling it, and this is the bank you can that you could get those shares from. Okay, so those are the documents that you can. Those are the set of information that you could find in a prospectus. Now, as soon as you get, or in response to the prospectus, members of the general public are expected to subscribe for or apply for the shares. That is, the subscription is usually done by filling and submitting an application form to that effect, and those from whom applications are received are referred to as share subscribers. That is the set of people that that have interest in getting shares of the company. Take for instance, okay, Nestle PLC wants to sell shares. The first thing they have to do is they would issue prospectus, and in the prospectus they will tell you that okay, we want to sell shares. Okay, this is the amount of shares we want to sell. If you want to buy, go to this bank, either Zenith Bank, First Bank, or whatever. They will tell you the bank that you could get the shares from. Then what you have to do, let's assume you have interest in getting shares with, in that company. What you have to do is you go by, fill in some documents, then you go to the bank. If you want to apply for the shares and the likes like that. And it should be noted that shares are sometimes not issued to the general public. And for shares that are not issued to the general public or individuals or corporate bodies, they are called private placement. So shares that are not issued to the general public and rather issued to individuals or corporate bodies, they are called private placement. Okay, so the issue of shares is the procedure in which enterprises allocate new shares to the shareholders. So when we say issue of shares, we're talking about the procedures in which enterprises allocate new shares to shareholders. And shareholders it could be either corporate or individuals. When I say corporate, I mean it could be either companies or individuals. So companies could also buy shares of another company. So companies can own companies. That's what I'm saying. So also individuals too could own companies. Alright. So the issue of prospectus, you have to take note of this. The issue of prospectus, receiving applications, allocation of shares, those three things, they are the three key fundamental steps of the process of issuing the shares. And large percentage of what we'll be discussing in this class would be based on those three processes. That is, the issue of prospectus, receiving application, allocation of shares. So you have to remember these three processes as time goes by. All right. So let's move to the next part of this class. Now we'll be talking about the types of issue of shares. Now, what are the types? What are the ways whereby shares could be issued? First of all, shares could be issued on, it could be public issue. And when we're talking about public issue, now this is the issue of ordinary shares directly to the members of the general public without any discrimination as to social or economic status. It is also known as public offer. When a company makes this offer for the first time, it is further described as initial public offer. That is, if it is the first time that the company will be issuing, their sales of shares to the members of the public. Once it is the first time, we call it initial public offer, which is at times you could see the abbreviation IPO. So IPO stands for initial public offer. And I said that public issue is when the ordinary shares are issued directly to the members of the general public without any discrimination as to social or economic status. All right. So the other types of issue of shares is the rights issue. Now, when we talk about rights issue, the issue of a company ordinary shares to a company existing shareholders. So it is the issue of company ordinary shares to existing shareholders. From the word rights issue. That is for people that already have shares in the companies. Now, rights issue is like, okay, they have the rights to, get or get more shares. And it is usually done in a proportion of the number of shares already being held by those existing shareholders. Okay, from the company's policy, take for instance, they want to expand their scope, they want to expand their business, and one of the ways to, don't forget, I've told you that one of the ways to get more capital or to get capital in companies is through sales of shares. And okay, we are saying we want to expand our business, and in this time around, we do not want to sell, shares to members of the public. So in that case, we are saying, okay, let's try to sell shares to the existing shareholders that we have. Okay, so those kind of issues is what we call the rights issue, and it is usually done in proportion of the number of shares already being. Take for instance, the proportion could be maybe 2 new shares for every 5 old shares held by each shareholder. So what that one means is for every 5 old shares that is held by every shareholder, we'll be giving them 2 new shares, and based on such proportion, an existing shareholders would say maybe 50,000 old shares would get 20,000. This is how we do the calculation. That is 2 new shares divided by 5 old shares times 50,000 units would give you 20,000 new shares. Also, if a proportion of one share for every four old shares held by an existing shareholder is used, then an existing shareholder with 50,000 old share will get 12,500 new shares. That is 1 divided by 4. That is 1 new shares divided by 4 old shares times 50,000 units. Alright, so that is that about rights issue. Another types of issue, okay, you have to take note that an existing shareholder has the option about rights issue. An existing shareholder has the option of either buying shares under rights issue or selling the shares to another existing shareholder or a potential shareholder. So basically, it might not be okay, and the existing shareholders might not want to buy shares at that point in time when the company is selling. So they have the right to either selling the shares to another existing shareholders or a potential shareholders. All right. So the next set of issues is the bonus issue. So when we talk about bonus issue, this is also known as scrip issues. It is the issue of new shares to existing shareholders at no charge to the shareholders. That is, it is free. However, you have to take note that someone somewhere would have to pay for that shares. So who is paying? So in this case, the cost of the new shares will be charged to the company. So it is the company that is paying for shares issued on bonus issue. But the question is, where is the company getting money for those shares that they are selling on bonus issue? So the company will be getting the money from their revenue reserve account. So revenue reserve account, I believe I could remember vividly while we were discussing about provisions and reserve. That was in second term. We were able to discuss about provisions and reserve. So I expect you to understand what we mean by provision and reserve. However, for companies, revenue reserve account, companies do have revenue reserve account, which is the accumulation of profit that they do not distribute at the course of the year. But I mean, in their previous years, I mean, during their previous operation and the likes like that. So companies like that could, probably want to expand their business, and at the cost of expanding their business, they could make decisions of, okay, we want to give our existing shareholders new shares, and it will be at no charges. That is, it's going to be free. So the money for the cost of giving them new shares will be borne by the company, and they will be getting the money from either their revenue reserve account, that is if they have, or it could be borne, or it could be charged to their share premium account, or in most cases, or they could charge to both, that is both revenue reserve account and share premium account. And this implies that the total monetary worth of the bonus issue must always be less than the amount of money available in the reserve revenue account or share premium account at the point of the issue. That is, before a company could say, okay, we want to issue new set of shares and it's going to be charged, it's going to be borne by us, that is going to be charged to our revenue reserve account. Definitely, that means that they must have had enough money in their revenue reserve account. Because if you are saying you want to dash someone money, definitely you have to have some money somewhere. So if they do not have any money anywhere, that is, they do not have money in their revenue reserve account, it won't be possible for them to issue, to issue shares on bonus. So that is to say they will have to have money. They have to have enough monetary worth of bonus of money in their revenue reserve account before they can do that. All right. So the next set of issue, which is the last, is the conversion issue. Now, when we talk about conversion issue, from the word conversion. So this conversion denotes the replacement of convertible preference shares or debenture. Okay. So later in this class, we'll be discussing about preference shares, other types of shares. So, but I want you to know that when we talk about conversion issue, we're talking about the replacement of the convertible preference shares or debenture. Okay, so when we talk about debenture, what is debenture? Debenture is more or less, another name for debenture is loan notes. And debenture is when the company is getting loan from individuals. Okay, so when a company is getting loan from individuals, they issue debentures or issue loan notes. It is mostly a long-term loan. That is loans that covers for periods over 1 year. So in that case, if a company is if they are saying for this loan that we have gotten from this particular individual, can we probably do some kind of negotiation whereby we would convert the loan from loan to a capital, which is shares. So in that case, that process is what we call conversion issue. That is the replacement of convertible preference shares or debenture with ordinary shares. So whenever there is a replacement from debenture to ordinary shares or preference shares to ordinary shares, we call that process conversion issue. And in this case, a given amount of convertible preference shares or debenture will be divided by a conversion price to arrive at the number of ordinary shares into which they will be converted into. All right, so let's move to the classes of shares. Now, when we talk about the classes of shares, there are three classes of shares, which are the ordinary shares, the preference shares, and the deferred shares. Now, when we talk about ordinary shares, what is ordinary shares? In ordinary shares, there are some textbooks that they will tell you that ordinary shares or ordinary shareholders are the real owners of the business. They are shares whose holders participate in making decisions over certain critical matters of the company that issue the shares. Okay, so let's discuss about the features of ordinary shareholders so that we'll get to understand who an ordinary shareholder is properly. All right, so the first feature of an ordinary shareholder is that they exercise voting rights over certain matters like appointment of directors, hiring of external auditors, and the amount of dividends to be declared by the directors of the company. So, you would agree with me that if you're not a real owner, if you're not an owner, like if you're not a key owner of the business, you won't be able to have the power to decide for the appointment of the directors, hiring external auditors, and because these are key functions of the company. So that is why some textbooks say that the ordinary shareholders are the real owner of the business. So they exercise voting rights. Another features of the ordinary shareholders is that dividends are earned by holders at no fixed annual rate. Compared to other shareholders like preference shareholders, that dividends are earned at fixed annual rate. So for these ordinary shareholders, their dividends is not at a fixed annual rate, because another feature is that there may be no declaration of dividends to holders in a financial year in which the company suffer a loss or does not make sufficient profit. So in this case, for ordinary shareholders, there may be no declaration of dividend to its holders because it's just they're more or less like the real owner of the business, as we've said. And in this case, when the company is not making profit, because it's your business, take for instance, it's your business and you're not making profit. So how do you expect to get the dividend? So in that case, there will be no declaration of dividend to its holder in the financial year, compared to preference shareholders that even whether the company is making profit or not, they have to declare dividends for some set of preference shares. Don't worry, by the time we get to preference shares, we'll get to unleash more of their features. All right, so the another features of ordinary shareholder is that the owners are entitled to the reserves of the company, because it's more or less like the owners of the business. So when we're talking about the reserves of the company, that is the final profit after everything has been, after you've settled everything that relates to them. So the final, the reserves of the company, they are entitled to such reserves, because at the end of the whole thing, you settled. Take for instance, at the point of liquidation. When I say liquidation, I'm saying when at the point of winding up of the company. So when I'm saying liquidation, I'm saying winding up of the company. I'm referring to times when companies is no longer existing. That is the end of the company. They are not operating again. Okay, so now you understand what liquidation and winding up means. So at the point of liquidation or winding up, or when the company is not existing again, the reserves of the company, that is what they have left. So this set of people, which are the ordinary shareholders, are entitled to such reserves. That is, they can take away, and they would decide on whatever it is they want to use those money for. All right. So another feature is that in the event of winding up or liquidation, holders of these shares cannot receive any settlement until all creditors and other classes of shareholders have been settled. So that is, in this case, at the point of we are not doing business again, the first thing is they have to prioritize some set of people. They have to settle them. The people that the business are owing, they have to settle them. The other shareholders, like preference shareholders, they have to settle them before they settle this set of people. Because don't forget, you are saying that they are the real owner of the business. So in that case, they have to wait. Let's settle other people first before they settle them. Okay, so those are the features of ordinary shareholders. All right, so let's move to the next class of shares, which is preference shares. Now, when we talk about preference shares, from the word preference, I remember at the course of the introductory class of in our economics, we've been able to discuss what preference means when we're discussing the scale of preference. So when we say preference, like you're giving some set of people some power, like priority. Like, okay, preference, another name for preference is like priority. All right. So when we say preference, now this set of shareholders do not participate in making decisions over some affairs of the company. However, they are given priorities in terms of, don't worry, we'll get to unleash them by the time we explain the features of preference shares. Now, for the features of preference shares, the first feature is that holders of these shares cannot exercise voting right over matters concerning the management of the company. Unlike ordinary shareholders, that okay, the appointment of the directors, the appointment of auditors, and the decision about the dividend sharing is saddled under with the ordinary shareholders. Unlike these preference shares, they have no right. They cannot exercise voting right over any matter. So another features of preference share is that holders of these shares receive dividends ahead of ordinary shareholders. This is where the word preference comes in. So they are under obligations to. The company is under obligations to settle them first before ordinary shareholders. All right. So another features of preference share is that dividends are earned by holders at a fixed annual rate. So they have a fixed, because for every preference shareholder they have a fixed annual rate that okay, year in year out they will get this particular annual rate. Unlike the ordinary shareholders, if the business is doing like extremely, they are doing very well. Okay, so after giving the preference shares, they will now settle the ordinary shareholders. So the ordinary shareholders do not have fixed annual rate, unlike the preference shares that they have a fixed annual rate. So if the business is doing well, they will get the fixed annual rate. If they are not doing well, they will still get their fixed annual rate. Another feature is that holders of these shares are not entitled to the reserves of the company. They are not entitled to the reserves of the company. All right. So unlike the ordinary shareholders, that they are entitled to the reserves of the company. And lastly, in the event of liquidation, holders of these shares are settled ahead of ordinary shareholders. So it's more or less like opposite of what we've said in under the features of the ordinary shareholders. So in this case, they settle them ahead of ordinary shareholders. So ordinary shareholders settle them after they must have settled all the creditors and the other classes of shareholders. So let's talk about the types of preference shares. When we talk about preference shares, we have types of preference shares. The first type is the redeemable preference shares. Now when we talk about the redeemable preference shares, from the word redeemable, redeemable is just being able to buy back. Okay, so when we say redeemable, so these are preference shares which are meant to be fully repaid by a company to its holder by the end of a stipulated number of years, known as maturity period. So that is to say, for this set of people, okay, they have preference shares, quite alright, but that preference shares is redeemable. That is, the company can buy back that shares. It's just like this thing is the way this thing works. It's just like the company is collecting loan. It's not a loan, so to say. It is a share. But it's just like, okay, the company is collecting loan from people, from some set of people. And the kind of loan they are collecting from them, they termed such loan as a redeemable preference shares. That is to say, okay, for this loan, after take for instance, 10 years, so after 10 years, the company would buy or would return your money back to you, and they would buy back that shares from you. So that is the way it works for this set of people. So the redeemable preference shares are the shares which are meant to be fully repaid by a company, that is fully buy back by a company to its from its holder by the end of its stipulated number of years, which is known as the maturity period. So we have another type of preference shares, which is the irredeemable, from the word irredeemable, like the opposite of redeemable. That is, now for this kind of shares, they are not meant to be repaid by a company to its holder unless the company is being liquidated. All right, so we have another type of preference shares. We have the cumulative preference shares. Now, when we talk about the word cumulative, I believe from your knowledge of statistics, you must have. This is not the first time you're hearing the word cumulative. Cumulative is like adding up. So preference shares are described as cumulative if unpaid dividend in a particular financial year, probably due to maybe insufficient money in the business or no profit, those unpaid dividends could be carried forward for payments in subsequent financial years. Okay, take for instance, in the year 2020, across the world, we have the outbreak of the coronavirus. the pandemic issue and the likes like that, most businesses are not doing well. So in that case, for the fact that business are not doing well, there's every tendency that business will be recording less profit. So for this set of people now, there's every tendency that they will not get. I mean, companies will not make enough profit. So in this case, for the fact that business are not making enough profit, that does not mean they will not get their profit. Even though they might not pay them in 2020, their profit could be carried forward to the year 2021. So what I'm saying about cumulative preference share is that if there is any issue of unpaid dividend in a particular year, those unpaid dividend could be carried forward for payments in the next year. So that is what we're saying. So that is what we mean by cumulative preference shares. All right. So we now have the next set of preference shares, which is non-cumulative preference shares. Now, for the non-cumulative preference shares, it's just the direct opposite of cumulative preference shares. So for this set of people, now if unpaid dividend in a particular year may be due to no profit, so it cannot, if there is any unpaid dividend, it cannot be carried forward for payment in subsequent years. So for the fact that they are not getting the dividend that year, it is gone. I mean, we are moving on. So that is what we mean by the non-cumulative preference shares. All right, so we are moving to the next section or the next classes of shares, which is the deferred shares. All right, we've talked about the ordinary shares, we've talked about preference shares. Now the deferred shares, which is the third and the last. Now for the deferred shares, we said these are these shares are also known as founders shares. For most textbooks, you might not get to see these deferred shares. Now, however, you have to take note that deferred shares are also known as founders shares, and they are shares which are issued to promoters of the company and principal officers of the company, like its executives and directors. So, and don't forget, at the course of our video on company and accounts, we explain who a promoter of a company is. So and we explain that promoters of the companies are the people that has the idea. I mean, the visionary, the person that has the idea about the company, and go about with the process of the formation of the company. So that is who we define a promoter of a company to be. So for this set of people, for principal officers and for people like executives and directors of the companies, so the kind of shares that are being issued to them is what we call the deferred shares. Okay, so let's discuss about the features of the deferred shareholders, so that we'll be able to understand or have a proper understanding of what a deferred shareholder means. And one of the features is that the holders do not receive dividend until all other classes of shareholders have been paid. Because these deferred shareholders they are classified a little bit higher than the ordinary shareholders, because they do not receive dividend until all other classes of shareholders have been paid. Another feature is that the shares cannot be treated like preference shares and ordinary shares. I mean, it is given to some set of people, like just as I've explained, like the promoters and the principal officers. And also, the holders of these shares receive relatively large portion of profit after ordinary and preference dividends have been paid. So this set of people, they receive the large portion of profit. You know what I mean? All right. So the next set of features is that the holders cannot redeem the shares for as long as they are still members of the company. So the holders cannot redeem the shares for as long as they are still members of the company. And also, in the event of liquidation, holders of these shares cannot be settled until all creditors, all preference shareholders, and all ordinary shareholders have been settled. So, don't forget, I've told you that they are treated a little bit higher than the ordinary shares. So, not until after the creditors, preference shares, and ordinary shareholders have been settled, they will not be settled. All right. So let's move to the next part of this class, which is the issues of shares properly. All right. So now that we have a proper understanding of the shares, the types of issue of shares, and the classes of shares, then we can move to the issue of shares properly. Now, shares can be issued on the following terms. There are three terms. The first one is shared issue at a discount, at a premium, and at par. All right. So when we talk about share being issued at the discount, from the word discount, what does discount mean? From our elementary classes, we've been able to know that discount is if you're giving discount, it's more or less like reduction. Discount is more or less like reduction in the original price of goods. Okay, you're giving discount, and now when shares are issued at a discount, that is to say your share is issued at an amount less, or yeah, an amount less than the less to the face value. Take for instance, oh, okay, I have a coin, like I have a coin with me, and the value of the coin is 1 naira. Or take for instance, the value of the coin is 2 naira, and at the point of giving out the coin, I'm saying, okay, can you give me the value of the coin is 2 naira, quite alright, and I'm asking you to give me 1 naira to collect the coin of 2 naira, which of course, if you have the coin of 2 naira, you could still get something worth 2 naira with that coin. So in that case, that means I'm giving you that coin at a discount. So whenever I'm giving shares at a discount, it's said that, this means that shares are quoted below the nominal value. When I say nominal value, I'm saying nominal value is the same thing as face value. So face value is the real value of that particular item. So when shares are given or quoted below the nominal value, it is said to be given at a discount. And the issuance of shares at a discount must be stipulated by the provisions of the Companies Act. Take for instance, shares of 3 naira nominal value will be issued for 2 naira. So it's said to be, in that case, we are saying that I'm issuing shares at a discount. All right. So when we talk about shares being issued at the next part, which is shares issued at the premium. So premium is more or less like, okay, it's the direct opposite of shares being issued at discount. Premium is I'm giving out at an amount higher than the face value. So shares issued when shares are issued at premium, it means issuing value is more than the nominal value, and the difference is called premium. So the premium will be regarded as capital reserve, and it will be posted to share premium account. Please, you have to take note of that. Whenever you're making profit on the issue of your shares, it will be treated, or it will be regarded as a capital reserve, and it will be posted to your share premium account. Please, you have to take note of all of these key points. You have to take note of that, because at the course of the week, at the end of the week, we'll be sharing some set of questions with you, which is going to be used as a basis of assessing your understanding about this particular topic. All right. Take for instance, shares of 2 naira nominal value issued at 5 naira. Shares of 2 naira nominal value, if it is issued at 5 naira, of course, you'll agree with me that the premium, which is the difference between 2 naira and 5 naira, is 3 naira. So the premium is said to be 3 naira. And it occurs as a result of, whenever shares are issued at the premium, it most likely occurs as a result of the attractive nature of the shares of the company. Because, of course, you'll agree with me, before a company could say they want to, sell shares at a figure higher than the face value, higher than the value itself, is because probably the company is doing so many things that is attractive and the likes like that. So that is making the shares of the company attractive. All right. So the next part is the next part is the shares issued at par. Now, when I say, or when you hear the word shares issued at par, what does it mean? It means that the share is not issued at premium, neither is it being issued at discount. So in that case, that means you are issuing shares at the exact value of its nominal value, which is exact value of its face value. That is, shares are not issued at the discount or at premium, but at the actual price. The actual price. Now this means that the nominal value is equal to the issuing price. Now you take for instance the share of 2 naira nominal value was issued at 2 naira. So in that case, you're not making profit, you're not making loss. So at that point in time, you are set to be issuing that share at a par. All right. Now let's take note. For all of these things, whereby for all of these times that you'll be using share either at premium, at discount, or at par, the accounting entries that you have to take note would be gotten from the initial part. When I told you that there are some key 3 things that you should take note of, and the 3 things are at the point of issuing shares to the members of the public, the first thing that the company would do is they would issue prospectus. Don't forget, they will issue prospectus, and the next thing is that the members of the public would apply, and the next part is that they would allot shares. So 3 things are happening there, and out of those 3 things, there are 2 things that would require some movement of cash, that would require movement of money, and those 3 things would have to show the accounting entries. That is how you have to post them, either in your journals or in your ledgers. So I'll be showing you the accounting entries of how to do the posting now. And for the first thing, for the first step, which is the issuing of prospectus, of course you'll agree with me that there's no movement of money, because it's just like an advert. Okay, something is happening, money is not moving yet. So in that case, there is no accounting entry. But for the second part, which is okay, application. Now, in the course of applying for those shares, the applicant will go to the bank to pay some set of money. Now, there are two methods of collecting money. When shares are issued out. And the first is payable in full on application. That is, they are paying for the set of people that are coming to buy the shares. They are coming to pay in full. That is, they are paying the whole money at the point of application. And the second is payable by installment. So when I'm saying payable by installment is, okay, I'm not paying the whole money at a go. That is, I'm paying in bits. Take for instance, okay, I want to buy things of 10 naira. I'm saying, okay, I'll pay 5 naira now. Tomorrow I'll pay 3 naira. Next tomorrow I'll pay 2 naira. So I'm spreading the payment of the money. So whenever I'm not paying in full, if I'm paying in bits, if I'm spreading my payment, that is what we call payable by installment. Alright, so in this video we'll be discussing about the payable in full on application. In our next video we'll be discussing about payable by installment. Alright, so